Hello, good afternoon, and welcome to the second half of the private equity session. We have Paul Daggett from Neuberger Berman, manager of NB Private Equity Partners, on the call from Dallas. We have a 10-minute presentation roughly, and then we're going to move on to really a conversation about the private equity market, how NB fits in, and as I said earlier today when we were talking to the Schroders Capital Global Innovation Trust, there's a significant number of companies now that are not publicly listed, and Bain have already highlighted in their report that 15% globally, 15% of companies with revenue over 100 million are publicly listed, which means that there's a very large number of companies out there that are not easy for retail investors to invest in. Hence why we think that the private equity space is very interesting, not least because discounts have remained relatively wide in the private equity space, and NB is not any different from that. First, so before we go any further, there is a Q&A function which I'm sure everyone's aware of, bottom right hand side of your screen. If you'd like to ask any questions, I will address them to Paul later on. But without further ado, Paul, why don't you do a quick presentation on NB private equity.
Sounds good. Thank you, Billy, and thank you everyone for joining today. So I'm Paul Daggett, a managing director at Neuberger Berman, and I'm going to talk about NB Private Equity Partners, our listed fund focused on co-investments, which I'll explain. So to start off with, just very quickly, why invest in private equity? 3 columns laid out on this page, starting at the left, outperformance, and this looks at global pooled private equity median numbers and first quartile versus the MSCI World Index. So of course, the first reason to consider private equity is the long-term outperformance that has existed that you can see here. The reasons for that probably have changed a little bit over time, but center in this middle column when talking about buyouts, which is what we're focused on, really around active ownership. Buyouts are majority owned by a private equity firm. That means that they control the investment. They're usually sector experts or experts in the particular type of company that they are buying, and that allows them to add value and to be really strong control investors, which makes the companies, or should make the companies, more agile in terms of how they are operated. And then on the right hand side, Billy just touched on this with the Bain number that he quoted, but of course it's diversification. These are companies that you couldn't otherwise access through public markets. They're privately owned. There's 25,000 of them owned by private equity firms across the globe, according to PitchBook numbers. So NBPE invests directly into buyout companies through what we call co-investments. So at the top of this page, it explains briefly what that is. Ultimately, we're investing alongside private equity managers directly into the equity of a single company, and we build a portfolio through doing that. The reason that happens is that very often a private equity firm might want to write a larger equity check than they can write from their fund, and they'll bring in trusted partners and limited partners to help them do that. And that's called co-investing, and it means you get a direct stake into the company alongside the control party, which is that lead buyout firm. It means that we can look at a lot of different deals. We can be highly selective. I'll explain that in a little bit more detail later. But the blue bars at the bottom of this page really explain what we think are the benefits of the co-investment model. And that is that we can diversify across sectors, across private equity managers. So we're a direct strategy, but we're investing alongside a large number of different private equity managers. In fact, there's 53 within our portfolio, and also by company size and enterprise value. We control the investment decision. That means that we have our own layer of due diligence, our own investment committee. Each co-investment we consider, we underwrite ourselves, and we decide whether we want to join in that investment. So it means we can be highly selective in what we do. Tied to that, we can also be dynamic with our investment pace because we're investing directly. We're not investing through funds. It means that we can start and stop investing when we think it's most advantageous. So we can be careful with the balance sheet when we want to be, and we can respond to market conditions and invest more quickly when we think that's appropriate as well. ESG due diligence, it's a part of our due diligence, is integrated into what we do. And that is something that we can layer on top of our due diligence when we're looking at these buyout investments and factor that into our decision making. And it's very important to us to do that. And finally, it's a very efficient way to invest in private equity because there's a single layer of fees on the vast majority of buyout deals that we do in co-investments, which means we're not paying a management fee or a carried interest to the lead private equity fund in most of the deals that we invest in, meaning there's a single layer of fees that comes through NBPE at the NBPE level. On the right-hand side, some summary numbers. Our gross IRR over 5 years in those co-investments is 14.5%. On average, over 5 years, the uplift on realizations or IPOs has been just above 40%. And over the same 5 years, the gross multiple on those realizations has been 2.3 times our invested capital. In terms of Neuberger Berman as a whole, we are a large investor in private equity. As you can see, we have $120 billion invested in private equity. That's managed by 300 professionals in the team in private equity in 16 different offices globally. And through this platform, we're invested in over 670 private equity funds. The pie chart on the right shows you the types of investments. The two I'll just mention, primaries are fund investments. These are not in NBPE today. That is a legacy part of what we used to do. Today, NBPE just invests in co-investments, but other parts of our platform does invest in primaries, and we have 40 billion under management, and that helps to drive the co-investment deal flow I talked about. And then the co-investment part, you can see we have $35 billion under management across institutional investors, commingled funds, and of course NBPE, and that means we've really been able to drive very strong deal flow that you can see the numbers on the top of the page, the 364 opportunities reviewed this year from over 200 different private equity managers. The portfolio today is $1.4 billion of direct investments. 93% of the portfolio is in equity investments. That's 88 investments alongside 53 different managers. And you can see that at the bottom right, the average age of the holding period is now 5 years. So it's a mature portfolio and very well diversified, as you can see on the pie chart on the left, with the biggest position Action being only just over 5% of the total portfolio. Again, looking a little bit more at diversification, the portfolio is weighted to North America. It is the biggest private equity market, and that is where we have found what we think are the best opportunities as we've been building the portfolio. So 74% North America, 24% in Europe, 4% rest of world. In the middle of the page, very well diversified by industry as well. Tech, media, telecom, consumer e-commerce, industrials, financial services and business services being the largest sectors within the portfolio. And then as you can see on the right, also well diversified by vintage year. At the bottom of the page, very importantly, I think, we're mostly invested around two key themes, which are businesses where we think there'll be low expected cyclicality, either because of the end market that the companies operate in or because of the particular business model that the company employs. Or on the right-hand side, companies that we think have long-term secular growth trends that drive their growth over time. These two things I think are very important, particularly in today's market, where of course it has been more unsettled and more uncertain. And then finally, on the portfolio, the top 10 companies, just to give you a bit of a flavor, you can see that on the right-hand side, these top 10 companies account for about 1/3 of the portfolio. And looking at the sponsor column in the middle, which is the lead private equity fund that we invested alongside, again, it illustrates the diversification that there's 10 different sponsors that were invested alongside in those top 10 investments. So we're not reliant on any particular firm for our deal flow or for our portfolio, but also well diversified by vintage year and by sector within this top 10. So again, I think the diversification, the quality of the portfolio illustrated on this page. In today's market, I mentioned over time, perhaps the drivers of private equity returns have changed. I think in today's market, our belief is that revenue growth and EBITDA growth are the critical drivers of private equity performance. And this slide looks at the LTM revenue growth and EBITDA growth on a weighted average basis of our portfolio in the 12 months to June the 30th of 2023. And you can see that both revenue and EBITDA grew on average by about 15% within that buyout portfolio. So we've seen very good growth, both organically and from M&A over that time period, which gives us confidence in the portfolio and how it is executing. Realizations is something that is very important within a private equity firm. Obviously, that shows that valuations are real, it returns capital and allows us to reinvest. And here you can see so far this year, in what has been a much quieter private equity year, in the 2023 year to date, the first 3 quarters of the year, we've had about $150 million of announced realizations. Some of those at the top of the page are through stock sales, which are sales of public equities that we own as a result of companies going public, and ultimately those being sold down by the lead private equity firm. And in the bottom of left of the page, these are realizations where either we've had a partial realization in those dotted boxes at the top with Action and PetSmart, or full realizations in the case of FV Hospital, Exedion, and Melissa & Doug. So we still have seen exit activity, and you can see again here that the multiple of invested capital that we've made on these investments since inception has again been very strong. So we're pleased with the level of liquidity in a more difficult year for private equity. The capital position and dividends. We pay a dividend twice a year in February and August. It's set as 3% of net asset value or higher. So currently it's 3.5% of net asset value, which translates to about 4.9% on the share price because of the discount, which I'll come back to, and obviously is the theme of this presentation today. But importantly, you can see that over time, we've returned $375 million of capital to shareholders through both dividends and buybacks. And this year we paid the dividend twice, and also so far $5 million of buybacks, which were, of course, accretive to the fund because of the discount. The capital position at the bottom, I think, is very important within a private equity firm. Again, because we invest directly, we have very low unfunded commitments. We're not investing through funds, so we have low commitments. So we are able to control our pace of investment, and we have $361 million of available liquidity. 300 million of that is through our credit facility, and then we also have cash and some cash that we're expecting to receive from pending realizations that have yet to close. So again, we think that the balance sheet is really important and something we manage very carefully as we look at the investment pace, particularly in a more turbulent environment like today's. And then finally, the NBPE performance, of course, critically important. The two charts show in the middle of the page our NAV return, and we compare that to the MSCI World. And you can see that over the long term and the medium term, we've outperformed the MSCI World with a 204% cumulative return over 10 years. Of course, the shorter term has been a little bit more difficult, and we can come back to that. But overall, we think the portfolio is in a really good place. Private equity is a long-term asset class, and our long-term performance has been very good. And then the share price performance on the right compared to the FTSE All Share. And again, you can see that the performance over the long term and the medium term has been very good. And over the short term, the shares still have increased. And of course, that includes the dividends, but of course, not as much as we would like. And that, again, factors into that discount, which today is 28%, which is longer than or higher than we would like it to be, and higher than we think it would be in a steady state environment. But of course, the private equity trust world generally is trading at significant discounts today. On the boxes on the left, the private valuation's up about 4%. The difference between that and the minus 1% that you see on the chart is those public equities that we do hold. Those have been sold down to some degree this year, but again, because of the public market performance of those shares, that means some of the publics are down, but the private's performing very well, driven by that earnings growth that I mentioned and the realizations I already covered. And with that, there's a summary slide. I think I've covered most of these points, and to save me going too far over, I'll end there and hand it back to Billy.
Thank you so much, Paul. That's great, and I appreciate there's a lot of lingo for people who are not necessarily experts in the private equity space. So just zooming out, maybe you could just explain how your approach, which as I understand it focuses 100% on buyouts, how that differs with venture capital or growth capital, just positioning the trust, I guess, amongst the range of different ways to access private markets in general.
Yeah, thank you. And I think it's a very important thing to differentiate, because although they're both grouped as private equity, as you say, within the private equity world, they're viewed as two separate sub-asset classes. I think the two most important differences are, first of all, buyout investments are majority ownership and therefore control owners. It means that they can replace management should they wish to. They can control the strategic direction. And of course, they come in with the intention of adding value because of sector expertise, because of experience with similar types of companies, and that type of thing. So what we're targeting when we're co-investing alongside a firm is a firm that has proven that they can add value to companies over time. And in particular, we look to invest alongside private equity firms in their core areas of expertise. So control, majority ownership is very important. The second key difference really, I think, is profitability. Obviously in the venture world or the growth world, you're investing in a newer idea for a product or a service that is being rolled out and developed, and you're hoping will grow significantly over time. Very often that means you'll have high revenue growth, but you may be unprofitable, you may be burning cash. Whereas in the buyout world, you're looking to acquire companies that in most cases are already profitable and more mature businesses, but more mature businesses that you believe can still be developed and improved. So when it comes time to sell that business in typically 3 to 5 years, that you can sell it for a profit because it's a better company. So those are really, I think, the fundamental differences.
And I guess not to is a difference also that as a control manager, you've got the decision about when to sell, and obviously being profitable, that means that you can even more so decide when to sell.
Yeah, absolutely, and that's true. Obviously, in the venture world, in the true venture world, typically companies have rounds of equity financing over time because they're burning cash. Whereas, as you say, in the buyout world, when you're a profitable buyout company, then you shouldn't need to invest more equity unless there's a strategic reason to do that, which means that, as you say, you can choose your timing. And obviously, you're looking to do that both when the company has reached a stage where you think you've really proven that it is a better company, but also the right time in terms of where the market is, which again, in part is why we have seen that slowdown with the equity markets dropping. Obviously, it doesn't feel like a great time to be selling assets, which is one of the reasons the private equity market is a bit slower at the moment. But absolutely, buyout funds, for the most part, can control when they exit their companies, and will try to time that advantageously.
And part of that is obviously that these funds, the typical private equity funds, because obviously listed private equity is only a very small subset of the private equity world, they have long-term fund structures, and everyone who's investing also has a much more long-term investment horizon. So it's a sort of a longer-term investment universe, I suppose, where everyone is expecting things to take a lot longer than maybe an equity hedge fund who expects, who might hope to make, 20% tomorrow or something in some sort of share trade. Interesting juncture to a question's come in from the audience saying, can you expand on the motivation behind the partial sale of Action? And this obviously we're diving straight into the detail now, when I hope to stay on the to zoom into the detail a bit later on. But well, maybe you could just explain the Action bit.
Yeah. So first of all, I think Action has been a really successful investment for us, and one that we are very, very happy with, and continue to strongly believe in. So really, that decision was that an option for liquidity came up, and we chose to take a small amount of liquidity, really just for portfolio management purposes. Ultimately, we look to be a well-diversified portfolio, and where we had the opportunity, which isn't always possible, where we had that opportunity to just trim the position a little bit, and obviously ultimately we can reinvest that capital into other things over time. So really just a portfolio management position, because it was clearly the largest investment in the portfolio, and fortunately still growing. So that was all there was to it.
No, I guess it's interesting talking about Action, because obviously one of the advantages of investing in a listed private equity fund is that you do get good diversification, and I suppose Action has been an incredible success in itself, but also for 3i Group, which is a listed, it's FTSE 100 listed private equity business, but I think it's something like 70% of the NAV, which is interesting given that you were trimming when it's getting upwards of 5%, or I can't remember the exact number, but so again, a totally different approach to portfolio management. Maybe you could just expand about how you see the portfolio and that the benefits of diversification.
Yeah, I mean, I think ultimately that is what we are bringing. We have a huge amount of deal flow that we see across our platform, and most of that deal flow is alongside very high quality private equity firms in deals that actually do get completed into portfolios of these various different private equity funds. As I mentioned, over 200 different funds this year that we've looked at deals alongside. So we have the ability to diversify while keeping the bar very high. And that's really the proposition that we bring in the portfolio. So, Action at 5.5% of the portfolio still is relatively small. But in a world where, we currently have 88 investments, and, we think that, maybe a little bit less, but we're at a level of diversification that we think is healthy, where any individual company still can drive returns. If you're 2, 3, or 4% of the portfolio, that's still big enough if you're very successful to drive returns. But of course, if things don't go as well or growth isn't as good, then there are also positions where any one position, you don't depend on it within your portfolio. So we're looking to bring high quality private equity exposure on a diversified basis to NBPE's investors.
Mm. And you touched on your sort of access. I mean, obviously, private markets is private, which it's not as simple as just clicking buy on a screen. Maybe you could just explain how NB fits in with the private equity universe, and explain maybe how it is that you can get access to these deals, and how your team go around optimizing the access they have to deals. Because obviously then there's another step, which is, you know, getting your spreadsheets out and working out what the right stock companies to buy are, which is a completely different and complementary skill.
Yeah, no, and absolutely, both are really important pillars of the investment process, the sourcing and the selection. But on the sourcing side, as I mentioned, we have 40 billion of commitments under management on our platform across 700 different funds with I think 280 different managers. So our primary fund investing relationships on our platform are very broad, and really we're looking to build those relationships as well as new relationships with funds that we aren't invested in at this point, and try to gather deal flow. But importantly, we also are able to act as a strategic co-investor, which I mean, we're not just a limited partner who is looking for co-investment as a part of a fund investment. We're also able to write large enough equity checks into co-investments that we can be a strategic partner to a buyout firm as they try to complete a deal. And so we can work alongside a private equity firm. We've got a large team, it can be very responsive, and we can write a large check. And that also really helps to drive deal flow, knowing that we're very professional, very quick in making decisions, whether that's a yes or a no. And those two things together, the fund commitments and the ability to be a strategic investor, are what really drives that deal flow. And as I mentioned, so far this year, on average, we've seen 11 private equity co-investments on our platform every week for us to choose between. And obviously that means we can be exceptionally selective about what we choose to participate in.
And then, I guess valuations, the public markets anyway, have had a sort of bit of a torrid couple of years. What are you seeing on your side? Because obviously private equity generally has sort of outperformed public markets. Does that mean that there aren't juicy bargains available for you to consider at good, attractive valuations, or how are valuations generally?
Yeah, I think in private equity, if you look at the statistics, the headline private equity average numbers in both the US and Europe have not adjusted downwards significantly for new transactions. This is over the last 2 years or so. And the main reason for that, in my opinion, is that really it's very high quality assets that are being brought to market. Buying more cyclical assets or assets that have issues and need to be fixed up is something we're seeing a lot less of. And so, within those numbers, I think you're maybe looking at a different set of companies today, not necessarily comparing like for like within that average. And so all of that is to say, we are seeing very good assets still transacting in the private equity markets, and assets that, within our platform, we are still participating in and believe that we can make private equity-like returns over the next 3 to 5 years. But, in terms of sort of those juicy bargains, we have not seen a lot of that coming to market. Ultimately, it goes back to what you said earlier. Private equity funds and very often founders, entrepreneurs, or strategics also have the ability to time when they choose to sell things. And obviously, for the most part, where they can, they will choose to defer a sale till a time when they think the market is more conducive to that type of deal. So all I'm saying is, while that hasn't been prevalent, but that certainly could change depending on what happens in the market.
Sure, and then sort of not to confuse things, but as part of the success of your investment strategy, I guess in 2020 and 21, the percentage of the portfolio exposed to listed or sort of quoted stocks, being effectively the result of a private investment becoming public, rose up to mid-teens. maybe you could just talk about that, and also maybe reiterating that really it's not really your decision whether you own those or not, because effectively they're under control of the underlying.
Yeah, thank you. So yeah, absolutely. Look, in 2020 and particularly 2021, obviously they were excellent markets to be taking companies public, and a number of our companies did IPO. When that happens, the lead private equity sponsor maintains control almost always of the equity in those deals. So although it's public, it's usually not distributed to us to do what we want with, because ultimately they want to choose how it is sold down alongside their own investment and their own fund. And so at the end of 2021, we did have a very high level of publics. And of course, those publics will fluctuate as the market determines. And today that's down to about $124 million of the portfolio. So it is a much lower percentage. Part of that is because there have been some sales this year. $24 million of sales of public stocks have occurred so far this year. And of course, it is also the case that some of those stocks did trade down in a couple of cases significantly. And so those obviously are reset and readjusted. So within the portfolio today, each month we mark those companies to those public prices, and that valuation is reflected in today's NAV, and of course the performance that I showed you.
And I guess obviously, notwithstanding the illiquidity of the portfolio, or the rest of the portfolio anyway, I think one of the, from my perspective, one of the things that NBPE differentiates itself with other peers is that it's able to really manage the balance sheet, and that's been illustrated historically by being more geared, I suppose, into the market historically. And I suppose in that context, maybe you could talk a bit about where you see the balances of sort of the firepower of being available for new investments versus buybacks, and maybe how the board, and obviously dividends as well, because they come from capital, but how it's obviously not your decision, but how do you view the sort of the balance between buybacks and making new investments? And obviously you're in a much better position to be able to manage the balance sheet as accurate as possible. So
yeah, absolutely. Just very quickly, one thing I should have mentioned, by the way, the public companies that we've had, again, the vast majority of those have been extremely successful investments. So I mentioned some of the downdraft that we had seen over the last 18 months to 2 years in those publics, but those that we sold so far, those companies on average had been a 2.1 times multiple. So one thing I should have mentioned, and I'll move on to the other question. In terms of the balance sheet, so we absolutely see it as one of the advantages of our model, that we can time investing and choose when to invest and when not to invest. We did slow down our pace over the last 18 months because we expected realizations to be slower. It meant that we felt we should balance that in terms of the outflows of capital into new investments. But today, we've had quite a bit of liquidity this year, as I mentioned. So I think we're in a really good position to consider what we do with that capital on the balance sheet. We have 360 million available between cash that we hold, pending realizations, and of course the credit facility. So very good flexibility in terms of what we do. And you also mentioned the ability to be efficient. We're ultimately 108% invested. The reason we can do that is that we have a zero dividend preference share, which actually matures next year. But that allows us to be more than 100% invested without feeling that we're introducing too much risk into the balance sheet because of our low unfunded commitments. When it comes to what we do with that capital, again, as I mentioned, we're seeing great deal flow, both in terms of volume, but also I think in terms of quality. So we're looking at interesting deals. What we obviously want to do is make sure we pick the right deals for NBPE. things that can be both, hopefully, most importantly, successful investments, but also complementary to the existing portfolio and that fit within those key themes, most likely. So that's important to us. But balancing that, as you say, there is also a decision that the board makes around buybacks given the discount level. And we have bought back $5 million of shares so far this year. What William said in our Capital Markets Day, which is on our website, and you can review for his exact wording. But what he said was, in his opinion, the way to view this is, of course, buybacks at a discount are accretive and immediately so. But of course, the discount is 28%. So the accretion is limited to that 28% when you make that buyback. And of course, that's a one-time event. And so while that in some circumstances can be attractive, what he compared it to was really our long-term track record of realizations over time of being more than 2 times our invested capital. If you look at the realizations over the last 5 years, they've been significantly over 2 times on average when those realizations have occurred. And of course, that can then be reinvested because it's not being bought back and it's available to reinvest. So he and the board, I think, want to balance those factors, and it really depends on the market and the outlook and the capital position, and it is something that is, of course, frequently discussed by the board. But that's, again, I think best said in William's words, which can be viewed in the Capital Markets Day recording.
Great, thank you. Well, I guess unless anyone's from the audience got any more questions, I've got, I guess, a final sort of outlook question is, we seem to be, as ever, in a situation where there's a lot of uncertainty and politics aside, if we avoid a recession, then presumably we're back to the races, and in a more stagnant economic environment, where does that, I guess, put private equity and buyouts?
Yeah, I mean, I think first of all, from our existing portfolio standpoint, we feel very good that we're positioned around these 2 core themes of lower expected cyclicality or long-term secular growth drivers. And while that doesn't mean that you're immune to a recession, we do think that would position us well were that to happen. In terms of the private equity industry as a whole and really what we do in new investments, I think that, obviously very often when there is more uncertainty in the market is where one of the things you mentioned earlier, pricing adjustments and different types of opportunities are more likely to arise. And so again, I think, we feel good that we've got capital available to invest. Again, we're not sort of sitting here with a base case of prices falling or bargains in the private equity world. But around the edges, certainly those type of opportunities are possible. I also think in terms of the existing portfolio, both for us and for other buyout managers, clearly that there may be a continuing opportunity for M&A because the larger platforms looking to buy smaller companies, either to build scale, build new geographic capabilities, new product capabilities, those types of opportunities are likely to still exist. And that's become a more and more important part of the market. And so again, from just NBPE's existing companies, I think in more uncertain markets, that M&A capability should still be possible. And we would expect to see that continue. And actually 70% of NBPE's top 30 companies have already completed some type of M&A during our holding period. And to look at it another way, if you look at the private equity market, 80% of private equity deals in the US in the first half of the year were for add-ons to existing companies. And so, again, I think in that type of market, that type of opportunity should still exist and may actually even increase. So, I think on a number of fronts, while recession is always something that we think about and obviously are concerned about, there's also some opportunities that may come from that.
Fantastic. Well, Paul, thank you so much for that. It's very thorough overview of NB private equity and also how the trust sits within the sort of wider private markets universe. Thank you all for dialing in and listening. And I think there'll be a recording of this made available later. Thank you so much for dialing in.
Thank you.